On December 14, 2016, the Federal Open Market Committee voted unanimously to raise the federal funds rate by 1/4 of a percentage point to a range of 0.5% to 0.75%. This was the second increase since December 2008, when the benchmark rate was lowered to a near zero level as an emergency measure during the Great Recession. The widely anticipated rate hike was a vote of confidence in the economy and a logical step as the Fed moves gradually toward a more normal interest rate environment. The federal funds rate is the interest rate at which banks lend funds to each other overnight within the Federal Reserve System. It serves as a benchmark for short-term interest rates as well as for the prime rate, which is the rate that commercial banks charge their most credit-worthy customers. The prime rate is linked to the interest rates charged on many types of consumer credit, including adjustable rate mortgages, home equity lines of credit, credit cards, auto loans, and small business loans. So the rates on these types of loans may increase with the federal funds rate. Fixed mortgage rates tend to be influenced by other factors, but could increase as well. Although rising interest rates make it more expensive for consumers and businesses to borrow, retirees and others who seek income from savings accounts, CDs, bonds, and other fixed-rate investments could eventually benefit from higher yields. On the other hand, rising rates tend to push prices of current bonds lower, so the impact on bond investors is likely to be mixed. Bonds held to maturity would typically not be affected. Stock prices are closely tied to earnings growth, and a stronger economy could help many companies. However, companies that rely heavily on borrowing may face higher costs going forward, which could affect their bottom lines. What's the rate outlook for 2017? The Fed expects economic conditions to warrant only gradual increases and projects a federal funds rate around 1.4% by the end of 2017. But future policies will depend on global financial developments, economic data, and growth projections. Inflation, which has been low, is approaching the Fed's 2% target for healthy economic growth. If it increases or decreases more quickly than expected, the pace of rate hikes may be adjusted.